Good morning and welcome to a secular bull market, bear market update. I do this every 6 months. Our customers and members have become used to it. I've been doing it for about I think the last 3 years or 4 years, every 6 months. And it's one that put a lot of preparation into just to see where this big picture perspective actually has us at the moment. So we'll get right into that. Before we do it, I must put up this notice as a requirement of our AFSL that everything we cover here today is of a general investment advice nature and not a specific investment advice nature, and that neither myself or any of my team know your specific investment objectives because we haven't sat down and gone through that with you. Right, that out of the way, what are the objectives of today's session? Well, it's really to do a big picture assessment of where the equity markets and some of the variables that affect the equity markets, where they're placed right now. And obviously we've had a huge event to happen on the planet with the coronavirus hitting us. But we can, and there's going to be positives and negatives that come out of this. And right now we don't know what those are. So the stock market is a place of immense uncertainty, even at the best of times. And I would say that this couldn't be classified as one of the best of times. So where do we go to as our source of input, of data to actually make our decisions? Because the stock market continues going, life continues on, and there are decisions to be made. So where do we go? And one of the places we've got to do, one of the things we've got to do, one of the places we've got to go to is the price action of the equity markets and some of the related variables that also interact with the equity markets. And the way that I do this is with long-term technical analysis. And sure, I do look at some fundamentals, which we will look at, and some of the sources that I get that from. But ultimately, those are just variables. They're all variables that lead into this melting pot called the stock market. And there's going to be a net aggregate decision made by the herd, by the crowd, on a sentiment basis, which includes logic and emotion and all the different parts of a human being that goes into decision making. And that's going to play out by either prices rising, going sideways, or falling. And that's what we are going to look at today. I've got to also say that past performance does not guarantee future performance. There are no guarantees in anything in life, but they do give us a really, really good and valid insight into what's happened and what may happen, or we have an idea of what may happen. But the big thing about the past is not so much trying to predict what's going to happen. It's looking at how human beings have collectively made decisions in an uncertain, an inherently uncertain environment like the stock market, and how they might make decisions going into the future. That said, we don't predict. What we do is wait for the price action to talk to us, and we listen to that, and we read it, and then we react. And that's effectively how we use past performance, past price movement in the equity markets. And that's really what we're going to be looking at today. And then we take that past movement, price movement, and we put probabilities on what may happen in the future. And then we take risk based on those probabilities after we have put in place a pre-definition of what our risk may be. So a little bit more about that in the coming minutes. Firstly, the stock market continues to have it climbs a wall of worry. We know that, and it continues to have variables all the time, day in and day out. Never been any difference that there have been things to worry about. So we don't ever have a riskless environment, ever. It's degrees of risk or risklessness that we are assessing all the time. And the main wall of worry item on the agenda at the moment, and has been for the past few months, is the coronavirus COVID-19 lockdown. And that's really right across the whole world. And how does that affect the stock market? I'm not going to get into any health issues here today. I'm not going to discuss any rates of infection or anything like that. We're going to look specifically at how the stock market is handling this situation and get some insight into that. But one of the main things that's going to do is, as we know, is that it's going to affect company earnings, and there are going to be some massive declines in some company earnings, but will that happen for all companies? And the answer is no. We never get 100% in any environment of everything getting affected negatively, in the same way as no matter how good things are, when good times are rolling around, is we never get 100% affected positively either. There are winners and losers in every environment that we're in. And so people who are very bleak at the moment and can only see downside, well, there is going to be some potential for upside. The other thing that we know is going to happen out of this, with trillions of dollars going into trying to support countries by governments, is that government and private debt, which were already high, are going to go even higher. So we're going to see debt to GDP ratios rise quite dramatically, and what effect that might have on companies, on countries, and specific environments. So these are some of the variables you're looking at. I'm seeing questions are coming in. We'll go at the end, go through all the questions that have been asked. So Andrew, if you can be patient, I'll certainly get around to that one. In fact, I'm probably going to answer that as we go through this. Right. There's also the China-US trade wars. Are they out of the way? Certainly not getting anywhere near as much coverage as what they were, but they're still ongoing. They're not complete yet. And what about some other geopolitical wars, in inverted commas, that are happening as a result of the coronavirus? We're also in year 4 of the presidential cycle. That's a big variable, and that's something that we can't ignore either. That's also playing on decisions that are being made. We also had an inverted yield curve happen in August last year. And my point there is what effect is it going to happen? Is that going to have? Because we do know that there's a delay on when the yield curve inverts and when we have a recession. But my point there is that the economy and the stock market are never in sync. In fact, that delay is one of the things that is as a result of the stock market and the economy never being in sync. But there's also one strange slush ball that's come into this environment, having had the inverted yield curve, is that we've had the stock market react to another big variable before the recession. So what effect is that going to have? I don't say that I've got the answer to that, but it is an unusual environment. We've had a big correction in the stock market before the recession, and the recession is still going to come. So how will the stock market react to that? We also have interest rates falling. We'll look at this right at the end of the session, and we'll look at the yield curve and interest rates, long-term interest rates, particularly in the US, because that does drive things, and what effect that might have. And I just leave this question at this stage, which I'll come back and answer later. But who is game enough to fight the Fed? Because certainly we've got this huge, big health variable that's affected the whole world, including economies and the stock market. But how is the Fed and all the other Feds, in inverted commas, around the world reacting to this? And how might that play out? And what effect might those variables have on the stock market, which is what the environment is, which we're really talking about here today. So this focus is on the stock market and how it's going to react to this repeated wall of worry that we always have in our lives and never, ever go away. Right. Let's first deal with the presidential election cycle. Here's a chart. I've had a different chart up in previous sessions. And they all show, if you've got a long-term view, or enough data going back many decades, they all show pretty much the same. Year 2 is the lowest, and year 4 is the second, and year 3 has been the best. And no matter which time frame you look over, if you've got at least 50 years of data, that's what's going to come out. And this is a total return that includes dividends, and it's the US stock market using the S&P 500. So here's year 4, and year 4 at the moment is in the red. But that doesn't mean there's no dead cert that means it's going to turn around and achieve this sort of, because that's an average, remember, as well. And but it's just something to take into consideration, is that given a semi-normal environment, is that year 4 does do well on the stock market because it's within the interests, year 3 and year 4, that is, because it's within the interests of the incumbent president to create an environment whereby that is the case. It's not the only variable. It is a variable, and it doesn't override everything else that's going out there, but it's one to take into consideration. Now, I'm going to start when I get into the charts that I've got going to get into now. I'm going to talk mostly about secular bull and bear markets, but just to put that into perspective, I won't talk much about primary and secondary bull and bear markets because that's a lower level that we don't need to go to in this big picture perspective. But just to put it into context, at the lowest level, and you could even go one low if you wanted to get into really short-term charts, but really we talk about secondary bull and bear markets, which are a subset of primary bull and bear markets, which are a subset of secular bull and bear markets. So the word secular here really means ultra long-term or long-term. So that's really the context in which the word secular is used in today's session. So let's go and look at the big picture now. Having done this, and I'm going to get through this a lot quicker than what I have in past years. The email you got had some background. You could have gone and done that research and seen this in a bit more detail that I'm going to cover here, but I'm going to step through it pretty quickly. And if you want to see a longer explanation of this, you can go and look at previous webinars that I've done and recorded presentations that I've done on the secular bull market, but I'm just going to go through this pretty quickly. I'm using the S&P 500. We will look a little bit at the All Ords in a moment as well. But effectively, this goes back to 1928, just before the 1929 crash, which you can see bottom left, and goes through to current. I think about a day ago is where the closing price is in the top right-hand corner. Effectively, we had a 20-year secular bear market, long-term bear market, sideways ranging, and what happens, one of the traits of a bear market, a secular bear market, is the wide ranging, is that we can have up to 50-60% falls in such a market. So we have wide ranging, big falls, big rise ups, and far more volatility, but we don't make a new high for many years. Eventually, you make a new high and you go up. And then there's another secular bear market that occurred there. It was 13.8 years from 1965 thereabouts through to 1982. And there we had one big fall of 49% over 1.7 years. But the previous, I think, was near 40% fall. And that is a big sideways movement. Eventually get a breakout. And we go up to the next secular bear market, which is the 2000 to 2013. Secular bear market, two big 50% falls on the S&P 500 in Australia. The first one, the minus 49, was about a minus 19 here in Australia, but big wide ranging. And eventually we have a breakout, which occurred in April 2013. So those are secular bear markets. And in between, we have secular bull markets. Now, the secular bull market starts at the breakout. But what you'll also see, which I'll put up in a moment, is that we have a big run up to get to the breakout point. So we'll put those into context in a moment. But here we had from that breakout to that peak. Now, we didn't know that that was the end of the secular bull market when we got to that peak. We were still thinking things were going up, had a retracement, found support. And here what we see, one of the traits is that a secular bear market battles to make new highs, whereas secular bull markets makes new highs in relatively short periods of time, maybe in a few months or certainly in maybe even a year or two. But that run from there over 18.3 years was a 465% rise from breakout to peak. The next one was the 1982 through to 2000. That was a 1,200% rise over 17.6 years. Notice the similarity between 17, 18 years. And this is, where Martin Pring in his long-term big picture analysis in his book, Technical Analysis Explained, speaks of the 18-year cycle. So there is roughly that. And then we had the secular bear market. Then we've started a new secular bull market in April of 2013. So we're 7 years into the secular bull market. And the big question, which I'm going to try and answer today, is the secular bull market over? And we'll get to that in a few slides' time. But we've had an 82.3% rise over 7 years. So the question that we have in our mind, and remember, this is all unknown. There's no dead certs here. We're just talking probabilities, and we're looking at the past to try and gauge what may happen going forward in the future with all the variables that get thrown into this. We've had world wars, we've had the 1987 crash, we've had 1929, we had all sorts of things happen over the last 92 odd years that are shown in this chart. So we'll talk a bit about where the secular bull market is still intact or not, and what it would look like to say no, it's not. Now, also just quickly to go through this is that to come out of the secular bear market into a secular bull market, we had a rise from the last trough. Now, we don't know when that trough occurs that it is the last trough of a secular bear market, but the breakout occurs. So took 8 years from that trough to the breakout point that eventually led to the next secular bull market, and 154% rise. In the 1965 to 1982 secular bear market, it took nearly 8 years, but had an 88% rise to break out. In the last one we had from March 2009 to the breakout in April 2013, 135% rise over a much shorter period of time, 4.1 years. Now, let's look at the total move from the last trough to the peak that defines the end, as we come to know after a while, that defines the end of that secular bull market. So we're combining both. Quarter of a century, 1,300% rise. There, another quarter of a century, 2,300%, 2,353% rise from last trough to peak. And remember that the 1987 crash, it was right in the middle of that, a 33.5% crash in inverted commas, that took 55 days to occur. Some similarities there. And at the moment, we're sitting on a 321% rise over 11.1 years so far. So where are we now in the context of this? Well, that's what we'll talk about in a few moments. But this is really a big picture to try and put into context the long-term big picture secular cycles that occur in financial markets. And now we've just had the COVID-19 crash, a 33.9%. This is on the S&P 500. The All Ords went 37% to its lowest close, but that occurred in 33 days, that crash. Some similarities to the 1987 crash. Does that mean we're going to turn around and go higher? I'm not saying that. I'm not predicting that. We're just looking at the past to see, has this happened before? Is this unprecedented? No. Is the reason unprecedented? Probably. But and even that's probably not unprecedented if we can go back further in time, and maybe even just slightly before this chart starts with the Spanish flu. So, there's nothing new under the sun. Sure, it might be new under the sun for us in this generation, but the planet has dealt with this before. And guess what? We got to times after the Spanish flu when we just had normal life and people were interacting at very close quarters. That may take some time before we do that. But in the meanwhile, we adapt. And there are unintended consequences that come out of this environment that are both positive, believe it or not, and negative. I think everything around us at the moment would believe that the only unintended consequences that can possibly come out of this are negative. Not so. And our job as active investors, as people that derive growth and income from this beast called the stock market, our job is to remain neutral. Our job is not to energize the positive in an extreme way or the negative in an extreme way. Our job is to have a neutral mindset and look at and create an environment, create a process whereby we can be objective in the moment to make decisions that are consistent and are stable and unemotional. And that's what we want to do. We want to remove the conjecture and everything else that comes along with it. We want to sift through the chaff of the daily news and be objective in the moment. So this is why we do this. We look at this big picture. We get this huge perspective to try and give us an objective insight into what's going on at the moment. So when you look at that, you could say there's potential for many more years of this secular bull market to continue. There's no guarantees of the future, but let's delve a bit deeper. So from the breakout, the actual breakout, and of an April 13 to current, we're looking at an 82% rise in 7 years. And remember, if we go back, let's just go back quickly and see what the corresponding ones that we are looking at. Those are the two that we are. Sorry, not those. That's what we're comparing here. So really, this is the secular bull market we're in. And we are comparing it to the potential of those two, the 465 or the 1200% in around about 17, 18 years. So looking at that, we could have another 10, 11 years to go on in the secular bull market. No guarantees, we could. But let's look let's delve in a bit deeper and see what defines the continuation or the ending of the secular bull market. A couple of points to make. First is that is the potential opportunity here is that the S&P 500 replicates either of the previous two secular bull markets. As you can see, we might be years away to get to that 17, 18 years, and certainly percentage-wise, we're 82% into a potentially 450 to 1,200% rise. So there is potential, but there's a wall of worry to climb along the way. And as I've said in the previous 3 or 4 years, is that there are potential falls, and that slide has not changed, but potential falls between 10 and 35% along the way. And guess what? We've just experienced one of those right now. Did I know that was going to happen? I had no dead cert way of knowing that was going to happen. Did I know COVID-19 is going to happen? No, I did not know that. But it's just the way that we play out. We make mistakes as a species along the way, that just these things happen. It just so happens that it's manifested it manifested itself this time through the COVID-19 virus. There could have been some other variable. In 1987, it was a total different set of variables that created the 35% fall in the equity markets smack in the middle of a secular bull market. So this time, it's the COVID-19 crash. And as I say, note the 1987 was smack in the middle of a secular bull market. So, question, how do you be optimistic? How do you remain optimistic about the secular bull market continuing? Because as an investor, we've got to be optimistic, but not in a way that we are complacent and cocky about it. And the way that we are not complacent and cocky about it is that we put in place an exit strategy. We've got to predefine our risk in every environment that we operate in. So that's how we are optimistic and remain optimistic, and why we can also operate while also risking another 33% fall or more from where we currently are. We have no idea which way it's going to go, but we want to open ourselves up to the potential of the future, if you like, and the big picture that I've just presented to you, while containing, mitigating, minimizing our risk. So let's have a look at this fall. Let's delve in a bit deeper over here. So on the S&P 500, we had a 33.9% fall in 33 days from February 19, I think that peak is, to I think March 23 or thereabouts, and which is about 5 weeks ago now. And we can see that there's been a run up, and there's been all sorts of discussion about whether this run up is a dead cat bounce, whether it's going to rocket down again, whether it's going to continue up. And to be honest, we don't know at this stage. Right. Is it the quickest in history, like everybody's been talking about? We certainly had that 33.9% fall in 33 days, but we had a 20% fall here in 13 days from that date there. I can't remember the exact date, but it's contained within this 33.9% fall. Because why am I looking at 20%? Because 20% is the official definition of a bear market. So that 13, if we looked at 20% from that peak to where it got to 20% down here, that was longer than this 13 days. That's a big fall. It's 20% in 13 days. Sometimes it takes a whole year to have a 20% fall. Is it the quickest in history? We'll see in a moment. Let's quickly look at the All Ordinaries. It had a 33% fall in 29 days, and then a couple of bars later, we ended up at a 37% fall, so we've had a deeper retracement here than the S&P 500, and a shallower run up as well from that fall. So at 29 days, pretty quick. Well, here's the quickest 33% fall in history in 19 days, from 10th of October 1929 to the 29th of October 1929. So there's the 30. So that's the quickest. So we certainly haven't had the quickest, like everybody's telling us. And there was a 20% fall close to that period in just 9 days in 1929. And remember, they didn't have the electronic environment that we have now, and how quickly news can scatter and get around the planet. And back then is what we have now. So certainly we're not the quickest. And what happened after that 33% fall? So there in the top left, I'm showing the 33% fall that occurred in 19 days. Well, there were 7 big legs down in the 1929 crash to end up having a total from peak to trough from the green from the green circle at the top to the red circle at the bottom. So from green up there to red down here, we had an 86.2% fall over 2 to 3/4 years. Could this happen now? It could. We have no idea what's going to happen from here. Certainly, I've just put to you the picture of the secular bull market versus secular bear markets, and we are in the middle of a secular bull market at the moment, and we'll have a look at the definition of the ending of that. But this could happen. And how would we position ourselves with respect to how we invest in the stock market to handle this? Okay, let's start looking at the definition of how this of calling the end of this secular bull market. So right now, as we stand, like we were, if you look back at 1987 as an example, that occurred smack in the middle of the secular bull market, which continued when the S&P 500 made a new high after the 1987 crash. So let's project forward what it's going to look like to define the end of the secular bull market. The first is that the market fails to make a new high. And that is, and I've put here 2 attempts to break into a new high. We could have 3, maybe even 4, but it's unlikely it's going to get to 4. And if it does, it's highly likely the 4th attempt will be the last. But if we have a run up from here on the S&P 500, bang our head at roughly the same peak that was made back there on February 19, we might retrace a bit, have another go, or we could actually just fall straight away from there, but we might go up and have another go, come back, and maybe even have a third bash at trying to get through. But if we fail to make a new high, then that is going to be a high probability it's going to be the end of the secular bull market, which would be a relatively short secular market. It would be 7 years, where we typically be looking at a 17 to 18 year cycle, because there's the breakout which occurred in April 2013. So that is a definition of happening. I'm not going to try and predict whether that's going to happen or not, but what we need to do is, and this will take many months to play out. It's not going to be days or weeks, and it might even take as long as a year or so to play out. We know it took that long for the S&P 500 to make a new high on the 1987 crash. So it could even take 2 years to play out. So we're not going to know from this scenario as to whether we're going to be moving into a secular bear or bull, moving into a secular bear and ending the secular bull. So let's just have a look at the NASDAQ composite. A similar thing, it's closer to that high, so we might get an indication from the NASDAQ before the S&P 500, just given that it's a lot closer. We'll look at that in a moment, how close it is. But if there's NASDAQ fails to make a new high, and with the huge role that tech companies play in the whole world at the moment, back then in 1987 and even in 2006, 2007 and 2000, where were the times? We had 2 bashes at trying to get through, 2007 and 2005, I think it was, at trying to break out above the previous high. There it is over here. Sorry, I should be looking. And sorry, it wasn't here. 2007 was over there. We're going to get an earlier confirmation on the NASDAQ, but we should give more credence to the NASDAQ now than what we have in the past, just purely because of the major role that it plays. So we need a confirmation between S&P 500 and NASDAQ is the point really I'm trying to make. The All Ordinaries are a little bit more difficult to analyze. Sorry, I did point over here. Let me just make so I think that's on the next slide. I'll make that point. On the All Ordinaries, we've got what I call a dividend overshoot. So trying to pick what the secular bear market on the All Ordinaries was is a little bit more difficult because of the underperformance of the cash index here in Australia and the overperformance when you add in dividends. So trying to compare it to the US market. So on a timing perspective, I've put the resistance level, upper zone, if you like, the upper resistance zone of the secular bear market at round about this level. And I've called this dividend overshoot just to technically, and I'm doing a normalization here, if you like, from a technical perspective as to where the secular bear market ended on the All Ords. So I'm calling this part dividend overshoot, and I'm saying that the secular bear market ended over here, went up, came and retested it. The timing over here of April 2013 fits in with the NASDAQ and the Dow Jones and the S&P 500 retested. So we've effectively been in secular bull market from around about this period over here. But we've got to recognize the previous all-time high as well, and include in this dividend overshoot. So looking at where the S&P, where the dividend, sorry, where the All Ords fails to make a new high is at that period over there. But we could also look at, I'll come to that in a moment. Sorry, I'm going to make another, that is not good. My apologies, hit the wrong key. I've got a keyboard in front of me that I'm not used to, but just zip back up to here. There's the dividend overshoot. Right, we are there. Fails to make a new high at that previous high. So if that happens, then that's going to be end of secular bull market on the Australian market as well. Another way that the bull market can end is if we move back into the previous secular bear range. So on the S&P 500, that would require falling all the way back down to over here, falling below, going back into the range, testing to come out of the range, staying in the range. Now, that's a pretty low probability of happening just because we are such a long way away from that range, particularly in the S&P 500, and that would require about a 50% fall to get back down into the range. So it's either not breaking out to a new high or falling back into the previous range. And if you look at that on the NASDAQ composite, it's also about a 50%. Now, this is where I've got a tech overshoot over here. This is what I thought I might have shown in the previous slide. It isn't. So this really, I'm defining that as the upper resistance zone of the secular bear market. The breakout there was around about April. Might have been a bit earlier on the S&P, on the NASDAQ at about February, I think it was, 2013. There's the overshoot. But we'd look at either a fall into the first instance, down below this all-time high, so call it getting back into the range. And that would require a 48% fall to get there, test, go back, or even all the way back into this range over here, which would be a 68% fall. Pretty long way away. So unlikely that's going to happen, but anything can happen. So we can't exclude that totally from our thinking. On the All Ordinaries, we were a lot closer to that. So if we're calling this, recognizing that as the dividend overshoot, this here was the upper resistance zone of the previous secular bear market, is we were a lot closer to that. An 11% fall, a retesting of that, and then continuing to fall would put the All Ordinaries into the end of a secular bull market. Let's look at the continuation scenario. Okay, from where we are, and this is a day out of date because I prepared these slides on Wednesday, so this doesn't have last night's update or the 2% odd run up that we had last night in the American market. So it excludes that, but from that point the day before, an 18% run up of around about 520 points. So the continuation of the secular bull market would see making a new all-time high, coming back down and testing that previous resistance, which would now become a support, and then continuing up and making a new high. Now, that could take many months, maybe even a year or two to play out. We don't know. But that is the definition of whether we, and I think this is where it's going to play out. It's going to play out as to whether we make a new high or not, or whether we see that point as a resistance. And that's going to take a few months, maybe even as much as a year or longer to play out. But that, if we see that happening, then we will have a continuation of the bull market. We'll talk about some variables as to what may support this or not in a moment. On the NASDAQ, similar sort of thing, a 13% run up or about 1,130 points, a breakout above, new high, come back, retest, and continue up. And the same with the All Ordinaries, although we've got a bit further to go because this run-up has been less, is that we need a 37% run-up of about 2,000 points on the All Ordinaries to get above, come down, retest, and continue up. But using this as the previous resistance zone and then calling this dividend overshoot and just the lower volatility that the Australian market has, I may put it at getting above getting above that high there and going up and coming down, testing that and continuing. That's round about the 7,000 mark and would need about a 10% run up, and that would correlate closer to the US markets given the difference in dividends. Right. So where are we in this in the secular bull market? It's still intact. There's no doubt about that. Technically, the definition is not in place to say that the secular bull market is over. And I remind, as I have in previous sessions, that bull markets, and this is a quote from Sir John Templeton, who's no longer with us, bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. So the key thing we're looking for here, outside of the technicals and the price movement, is have we experienced euphoria in this bull market over the 7 years that we've actually been in a secular bull market? And that the answer to me there is emphatically no, we haven't. What is euphoria? Euphoria is when everybody is talking about the stock market in much in the same way as everybody was talking about gold a few years ago, and that it was going to go to $5,000, $10,000, maybe even $20,000 an ounce, and it peaked at 19 and then fell, had about a 61% retracement to the low 1,000s. Similar to cryptocurrencies. Where Bitcoin got to as high as it did. I think it was $19,000 and fell all the way back to 4,000 again. But at the time that it got to 19,000, people were calling up and everybody was talking about it in the community, and there were people in that environment that had a riskless state of mind. It's when they cannot perceive risk. That is when we are getting euphoric. And we have got nowhere near that on the equity markets. And I would say that we haven't even yet got into, over the 7 years that we were in a secular bull market, we didn't even get into the mature on optimism phase at all. We have not got out of the skepticism phase, and that skepticism has grown even greater. And in fact, we may even have gone back into the pessimism phase. And that is where bull markets are born, back at those lower levels. So that, I think, is another way of supporting the technicals, but the real technicals that we need to see for the secular bull market continuing is that new breakout. Another quote that I like to use with our members is expect the best, plan for the worst, and prepare to be surprised, which came from Dennis Waitley, a psychologist many years ago. And what we need to do as investors is expect the best, plan for the worst. So how do we plan for the worst? We've got to predefine our risk. And we've also got to be prepared to be surprised, which means that preparing to be surprised, anything can happen at any given stage, means that when our exit signals, our exit strategy fires, we have to act on it. So, and you expect the best by having a plan in place, by engaging the market. Right, let's continue this to have a look at a few more points outside of the actual price action of the markets. I also, when I do these sessions, look at the S&P 500 inflation adjusted. Robert Shiller came up with this idea. So effectively, he puts interest rates into the S&P 500 and adjusts it for inflation. So it's like real. He normalizes it for the real returns, if you like. And just the point I want to make here that I've made in the past is that the S&P 500 making a new high based on the inflation-adjusted S&P 500 is that the technical cash index made its breakout run about there when the Shiller inflation-adjusted was there in 1950, 1982 there, in 2013 there. But each case, the Shiller, the inflation-adjusted S&P 500 eventually confirmed the secular bull market, as it has over here. So people that follow this and discount the cash index, what they would want to be seeing to say that we are no longer in a secular bull market is that the inflation-adjusted S&P 500 drops below that red line. Well, as of data up to April 28, it hasn't. But so it's adjusted for interest, for inflation, which is currently probably needs some updating, but we'd need to look at this in a few months' time to see whether it's fallen below that red line. At this stage, it hasn't, so that backs up that the secular bull market's still intact. You can also look at the Shiller PE ratio, the CAPE, which is stands for cyclically adjusted PE ratio, and he smooths this with I think it's a 10-month smoothing with a 10-month moving average, and obviously we've seen a big drop. And it's pretty early here from an earnings perspective, so we're going to see the earnings drop even more. And as earnings drop, the overbought, if you like, state of the S&P 500 is going to be adjusted down, because this red line really is where we say we've been. And you can go and look up this information yourself at that website, and you can get a 100-year, 100 plus, about 120-year Schiller PE 10 ratio, and you can also get the inflation adjusted S&P 500 as well. But that red line is where I've put overbought and oversold. And as the next quarterly and probably the next two quarterly reporting seasons come out, we're going to see profitability drop quite a lot. And of course, we don't know what the S&P 500 is going to do, but we are going to be able to get another state on whether the S&P 500 is overbought or oversold based on that being updated. But at this stage, it's not massively overbought like it was back here in 2018 and early 2019. This chart also comes from Robert Schiller's website, maltpl.com at the bottom over here, and it just overlays long-term interest rates over the CAPE ratio, the CAPE PE. And you can see that interest rates are continuing to fall. Over the last 50 years, the average has been 6%. We are now down to 0.73. In fact, I think it might even be lower. That 0.67 is what the 10-year is at the moment. Point is, interest rates are low, and the CAPE is falling. The other point that I made earlier was to look at was the 10 versus 2-year yield curve. This goes back to 1985, June 1985. You can see every time that in recent years there are times when it got a bit iffy, but a recession, being the gray zones over here, followed the inversion of the yield curve. In August last year, we just dipped below, very, very tiny dip below, certainly not as emphatic as going back there. But what this would imply, and people have been talking about it, is that this is another recession's coming. The difference here, as I said earlier, is that we've had the big stock market crash before the recession. So how is this going to play out? We don't know, but something to keep an eye on. And you can go and look this up yourself at Fred at .St.Louis, Fed, etc.org, and you can get that in the recording, or you can just Google it. But the big thing, the big difference here compared to the yield curve is that previous times the yield curve inverted, interest rates were high. So this is the 10-year maturity rate. So interest rates were high. This time interest rates are very low, relatively speaking, and in absolute terms as well. My point there is, don't fight the Fed, and that is one of the big things that is happening. What happened leading into this, and is happening again at a huge rate, if you like, is that the Fed is throwing a lot of money at this COVID-19 situation, and people who fought the Fed in the past have mostly been disappointed. So do you want to fight the Fed and not engage the market, or go with the Fed and engage the market, but with a plan in place? So which way from here? I'm finishing up now, and then we can get into a lot of questions that have come up. So which way from here? Nobody knows. If you take those main variables I've looked at, look at the price action, we can't sit here and with any degree of huge certainty say it's going to go this way or that way. So what do you do about it? Are you going to be a spectator or a player in this market, in the market at all? Because really, we've got another variable. That's all that's happened here is you have another variable. Sure, big, there's no doubt about that, but the world has had to, and stock markets have had to contend with pretty big variables in the past. And in the past, they've also come out of outside of the market and haven't been a direct economic variable that's played out. And this time it's the same. It's not a specific economy or a stock market variable, but they invariably do turn into economic and stock market variables. So how do you handle this variable? What is so whether you're going to be a spectator and a player, but what is the difference? What defines the difference between somebody who is able to play and watches, or somebody who's able to play and actually plays? Well, in my view, it's psychology in nature, psychological in nature. You know, the spectator is uncertain, probably more uncertain what they'd typically be. They're full of doubt. They hesitate. They distrust the environment. They fear more than what they typically do. We all got degrees of fear in us. And what that does is it freezes them into inaction, not knowing what to do. I do not know what to do. Whereas the player has a plan. And the player has a plan that they trust, that gets them to be objective rather than subjective, keeps them consistent in their decision making, removes emotion from the equation, and acts. And they act and they play because they have a plan in place. And what is the most important part of a plan? All of our members should know this. For those of you who don't, it's how you minimize the fear, uncertainty, and doubt. The most important, the biggest part of an investment plan or any plan, even in business, is predefining your risk and doing it very specifically with respect to the stock market, correct to 2 decimal places on every position you take in the market. So you've got to have a precise, exact exit strategy that when the actual criteria for that exit strategy are fired, they become hit. There's no wiggle room. There's no way you can talk yourself out of avoiding or ignoring that exit. You've got to take it. And once you have that in place, it liberates you to take risk, to make profit. Without the exit plan, you're going to have, without the exit strategy in your plan, well-defined, predefined before you take the position, the criteria are clear to you in your mind, you know exactly what it's going to look like. Without that, the fear gauge goes up, the uncertainty gauge goes up, the indecision gauge goes up, the hesitation gauge goes up to the point that you become frozen into inaction because you don't know what to do. When you have a plan on what you know what to do, then you are liberated to take risk. The other point I put up there in inverted commas, and the no wiggle room is in inverted commas because it came from the same person, and the person who made this comment, you don't need to know what will happen next to make money in the market, is Mark Douglas. Is one of his 5 fundamental truths, and you can look up the 5 fundamental truths or the seven keys to consistency, I think it is, and see what they are. And put that together in your plan, because that's how you take on this market. And at the moment, entry signals are firing. From a SPA3 investor perspective, the market risk is low. SPA3, ASX, and NASDAQ has gone low overnight, so now we're engaging in that at the moment. At the moment, the All Ords is not low risk, but we're waiting for that mechanical entry to do that as well. But entry signals are firing, and we are taking risk, and we are sitting in profit at the moment. Is that guaranteed to continue? No, but we are happy to engage because we have an exit signal in place that will protect our downside. And how else can you minimize fear, uncertainty, and doubt? Is if you are going to allocate capital, allocate it to a satellite portfolio that is part of a core satellite environment. And this filling this picture with how you allocate your capital across different strategies is absolutely key. And I make no apology for repeating this, because this really defines what your investment plan will look like. In your core, you might have approximately 50% of investable capital. So I know some of our members go down to 25%, would be defined as core, and they have more in their satellites. That's fine. It comes down to your risk profile, but define it, write it up in an investment plan, and fill the pictures that you might have that I'm going to put up here right now. But you want to have near passive or passive strategies in your core, buy and hold index ETFs or buy and hold stocks. I've had discussions with some customers in recent times who've got stock they've held for decades, back into the 80s, and they're saying, should I sell them? Well, it depends what strategy you're using for those stocks and where they fit into your investment plan. So the answer, I can't give that answer. The answer is how you write up your investment plan. You might have bonds, fixed interest sitting in here, cash, if you like, real estate, but these are your near passive allocation of capital into those strategies. And then you have satellites, and you can have as many satellites as you like, depending on how much time you have, how much capital you have, what your risk profile is, etc., etc. But you might have a SPA3 investor type active strategy where it's a growth strategy, it's trend following using technical analysis. And sometimes you can go 100% into cash, like we did in February, March of this year. And you might have a second active strategy which uses fundamental analysis or value investing, and it's a growth/income strategy. You can take income out or reinvest it back into the market to get growth. And this is mostly invested most of the time. It sits through big falling markets like we've just had, and it has low turnover. That's a strategy, but it comes down to how much capital you have allocated to it. You might have a third, a fourth, a fifth active strategy, and the one I just put up there is writing options as an income strategy. But write it up in your investment plan, and then you can allocate some capital to a strategy such as the ones that we use, Aspire 3 Investor, and it could just be, depending on how much capital you have, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60% of your capital in that particular strategy. But you know where it fits into the big picture, because that in its own self is risk management. How do you predefine your risk for every position in the market? Here's an example, Amazon. Amazon had a pretty shallow retracement during the COVID-19 crash, gave an entry signal back here pretty around about the end of March, and has done well. Did we trust that at the time? Well, it's difficult to trust it, but if you're an objective and you are a consistent, active investor, investing according to a plan, you define your risk, which was pretty big at the time. It is all the way down here, but you can see the risk has reduced greatly as the price action has gone up. And now at this stage, if it comes all the way back down to here, you'll still end up with a slightly profitable trade, but you have predefined your risk like we had the entire time along here. Well, here's another example on the Australian market is JB Hi-Fi. Had a profit trade over there, got an exit signal in, I think, mid to late February, had no idea COVID-19 was going to do what it did do to the financial markets, had about a 40% plus fall all the way down here from 40, in fact, that's nearly 50%, 40-something% fall from the exit strategy all the way down here. It's rebounded, and we now have an open position in that of the market. Why? Because we have our risk predefined if it does fall in individual stocks and the overall market, and we trust this, and we're able to take risk and execute to make profits because we have an exit strategy in place. And I've got one more slide to finish up with. After this, the proof of the pudding is in the eating, and that's effectively the equity curve that we've got out of thick and thin over the last 4.25 years, and we were out of the market there when it had that big fall down the bottom, and we engaged right now. So the proof in the pudding is the equity curve of an active investing, longer term investment system is beating the market, and it protects you when the market has a big crash. That was about a 12.2% drawdown from there to there when this had a 37% drawdown. And now we're looking to potentially make profits if the market rises. If it doesn't, we'll sell out and go into cash again and protect our profits. So if this goes all the way down to here, we will be out again. So just for those of you, a lot of our members still haven't read our latest white paper. Please download that and have a read of it. It talks very specifically about the psychology, about the actual execution of the public portfolio that we run, the real money public portfolio that we run. That achieved a 54% return in 2019. There are links in there to some of our members who achieved similar or better returns and who also protected from the COVID-19 crash. So it talks about our real money portfolio that we've used, but it also talks about there are customers in there with on-camera interviews who also talk about their experiences over that period of time as well. Let's go to sharewellsystems.com/white paper. If you just go to sharewellsystems.com, you are going to be asked to put an email address in to get the white paper. But if you go to /white paper, you don't need an email address. You can go straight into it. You can read it online. You can download it. You can do what you like with it. So asking all our members to please avail themselves of this. It's brilliant training and education on how to grow and protect money, and using purely on the Australian market, this one, although we do obviously look at the US market too. So in summary, secular bull market is still well and truly intact. And what we did today is we defined what the continuation would be for this secular bull market to go higher and continue. And we also defined what the start of a secular bear market would look like when and if that does happen in this particular cycle. So we know what that looks like. We've got that picture in our minds. The continuation or the starting of a secular bear market, we're not going to know for a few more months at least. Right. The other thing I want to make is that having anything can happen mind. There's a lot of negative news around. I've had some people who know what I do, who aren't members of ours. I probably use the word lambaste me and have a real high decibel go at the henny penny, the sky's going to fall on our head. There's absolutely no possible way that the stock market can go higher from here. There's going to be, I've even seen people online, not online, on TV, say that the stock market should be shut down for a year because it doesn't serve any purpose and every single company is going to lose money. That's just extreme thinking, and these are people that I have a little bit of respect for, even going on like that. And I just say that because there is this massive amount of fear, uncertainty, and negative vibe that's hanging over us. But what we've got to do is we've got to be objective in the data and the input that we take to make the decisions as to what we do. And where do we go for that? We go to the price action. Big picture first, and then a slightly smaller picture, and then smaller again. And we objectively look at what the overall voting machine of the stock market is saying about prices and where some companies can go and where others are going to go. So it's all about risk management first. How do we enact, actually physically enact and mentally enact the risk management? We have a well-defined exit strategy with no wiggle room. It's mechanical. It overcomes emotion, and that is why our members that followed the rules, and I've had so many of you say you have followed the rules in February when we started getting the exit signals, even in January for some of them, we just mechanically exited those, no question, and we protected our capital brilliantly. Have that in place first. Then when you've got that, it frees you up, it liberates you to use probability to profit. And that is what we're doing right now. We're just going on the probabilities to profit by taking our entry signals and exposing ourselves to the risk in the market. Why? Because we have the exit. The other point I want to make in summary is that the stock market and the economy are never in sync. They are just never, ever in sync. So that's what you've got to take. And it doesn't mean because it's guaranteed the economy is going to go lower that the stock market's going to go lower, or vice versa. It doesn't mean because the economy is really strong and going to go from strength to strength that the stock market's going to as well. It can go down. They're never in sync. So the best ways to take advantage of this opportunity is use a rules-based edge, overcome the emotion, overcome the noise and all the conjecture out there and the commentary and the day-to-day steady stream of bad news that we read in the media. Overcome that by having a rules-based edge, look at the probabilities, look at the price action, have an exit strategy that is timely and works. We've got plenty of evidence that the SPA3 investor exit works well. And deploy a core satellite portfolio allocation framework, the pictures I showed you, and see where the risk that you're taking with particular pockets of money fit into your overall investment plan. That is it. That's the end. I'm going to take some questions now, and there's quite a few that have come in. Right. First question has come from John. The last presentation you mentioned that the end of the secular bear market was a greater than 20% fall from the all-time high. Why was that? I don't know if I did that, John, because I doubt very much if I said that. So what John is saying is that I said that the end of the secular bull market would be a 20% fall from the all-time high. That's not true, because I've always said that the 1987 crash, that was a 33% fall from its all-time high then, and I've continued to say and have said for many years now that happened smack in the middle of a secular bull market, and that it did not define the end of the secular bull market. It didn't go back into the range at the time, and it then went on, and when it challenged its all-time high, it broke through. So I don't believe I ever said that criteria. The 20% fall is the widespread definition of a bear market, not a secular bear market. Certainly maybe a primary bear market, but not a secular bear market. A 20% fall does not mean the end of a secular bear market. Okay, Jane has said, could we see divergence between US and AU markets? US continues a secular bull while AU returns to secular bear. And if so, would we need to consider shifting our portfolios from AU to US? Has this ever happened before? Jane, that's a brilliant question. And I would say that could quite possibly happen. Anything can happen. And certainly that divergence between US and AU markets could happen. And you could think of some reasons as to why that may happen. The first one that springs to mind are the huge tech companies that the US has, that the whole world uses their products and their services, and some of these are just really software-based companies. They mainly software, and they don't have huge storage. They can operate from home, so they could withstand the really worst outfall from the COVID-19 environment. So and those companies could continue to be supported and bought and be profitable and even grow earnings in this environment. So so that could be one reason, but that could happen. We could see the US continue the secular bull market, make a new high, and we could see the AU either return to a secular bear or just go sideways and do nothing for a long period of time. It could happen. Then the next question is, should we consider shifting our portfolios from AU to US? One way that's difficult to predict and say, because look at what happened to the Australian market last year. It just absolutely did so well. And so did SPA3 Investor in that environment. So the best way to answer that one is to, you could have two satellite portfolios outside of your core, or one of each. And really it comes down to deciding, and there's no right answer as to how much capital you would allocate to a US active portfolio, a trend following portfolio, and how much you would put into and allocate to an Australian one. And you could have a 50-50, or you could say, let's maybe have a 60-40 in favor of US, or 70-30 in favor of US, rather than just doing all or nothing. Because remember, the currency also comes to it as well if we domiciled in Australia. Dennis is saying, a great presentation, thanks. However, is there a chance we'll get a choppy market for the next 6 months and lots of false buy signals and suffer from mounting broker commissions and numerous small losses? That is certainly a possibility. There's no doubt about it. The environment in which trend following does the worst is in a narrow, choppy, sideways moving market. Commissions isn't really an issue. You really shouldn't be paying more than sort of $10, maybe $10 or $15 minimum, and particularly in the US, you can do it for zero. There's some brokers. So commission isn't an issue. If you're doing it with a full service broker, then you shouldn't be, and then commissions could add up. But it's really a returns perspective is what you would do, what you would be thinking of there more, Dennis, than commissions. But you could have numerous small losses, and we'd need to take those small losses, because every big loss starts out as a small loss, and we want to protect against that. But a choppy market could happen. We don't know. And if that's the case, a choppy market for trend followers is one of the prices you pay, to be a trend follower, to protect the downside and to be in a market when it has really big runs. So you don't want to say, I'm not going to participate, because if you have a notion that we're going to have a sideways choppy market and you decide to be a spectator and the thing takes off, well, you've acted on a prediction and a notion that you didn't have enough evidence to say was going to happen. So it's a choppy market is the cost of doing business in with a trend following timing system, and that is why most trend following systems have between 35 and 55% win rate and don't have an 80 or 90% win rate. It's because the choppy market is what causes the losses. It's a cost of doing business. Jock is saying, thanks, Gary, great effort, especially at this time for the presentation. Bull market means up, bear market means sideways, not down. Certainly, a bear market really means sideways or down. Bull market is rising. That's the way I would do it, in the same way as a 0% trade, 0% trade after commissions is a loss trade to me, not a winning trade. So certainly a sideways or down is a bear market. Bull market is rising. We'll certainly, Johannes is saying, can you send me a recording? We will send it out to everybody who's attended. Steve is saying, thanks for an excellent presentation. I've got one critical question in regard to preserving capital when in 100% cash position and cash exceeds $250,000. Government guarantee. Sorry, this is Thomas. Government guarantee. Let's say, whoops, it's moved. Sorry, this is just moving around on my screen. The government guarantee said, say, over $1 million. How would you protect yourself in the proverbial hits the fan with a sudden freezing there's more questions coming. Sudden freezing by the banks and the government reset of the current financial system, which would decimate the value of any cash position. Appreciate your honest opinion. This issue, especially retirement phase. Wow, Thomas, that's a huge question. So what Thomas is saying is what happens if you've got cash that exceeds 250K, or even have 250K, so he's talking about a large amount, $1 million. But even if you do have 250K and the government decides to change the rules and reduces that or removes it, and the financial system collapses. Okay, that's a real negative environment. Let's don't discount it. Anything can happen. So where would you put that? One of the things that you could consider with that is in a very low interest rate environment, and also where dividends are going to be smashed, is gold becomes a potential player here. Gold is a store of value. It certainly, you don't get a return. But if that environment was coming along, or you were thinking of protecting against what you just said, then you'd need to be thinking of going into some hard assets. And gold is obviously one. The two main that very wealthy people use are gold and agricultural assets. And you would need to consider doing that to get around the safeguarding of the cash. And there are a lot of people talking about getting into gold in some degree or another, gold coins. In your instance, you wouldn't put it into the gold ETF because you're thinking of another leg down of a potential outcome over here. So you'd need to find gold as a hard asset and go to a gold bullion company or coins or something along those lines. But probably a gold bullion would be the one place you'd need to, and not necessarily all of it. You take some risk and say 250K is going to be guaranteed by the government, and trust that for the time being until it changes, and you'd need to take some and put it into gold. The really wealthy company or really wealthy people have some stash of gold all the time, around about 5 to 15%, and in there all the time, and they're using it as protection for what you're describing. If the proverbial really hits the fan and the whole financial system falls in a heap. And other hard assets are not necessarily gold. There are other hard assets you can look at as well, and you could even look at things like some of the exotics, like art and that as well, is where you'd be looking. But you'd also, from a stock market perspective, it would be safer also to have your money in some stocks invested through CHESS, through a HIN-based environment in Australia, where those stocks would have a better upside or long-term survival, being in a sector such as health, which and would be protected by CHESS, and that if the broker or whatever that you use fell over, that your investment in those stocks would be maintained, and would see and have a very high probability of seeing through such a massive decimation of the financial system. Of course, that would presume that not only the company survives, but stock markets survive. So you're really talking about a banned situation there, but you might think of health stocks that are always going to be needed. CSL comes to mind, and maybe some health providers as well. Really gone to a negative place there, but let's hope it doesn't come to that. And off the top of my head, without doing some research, you could do some research along those lines. There would be other avenues, I'm sure, as well. Okay, Mark has asked, does the continued flow of funds into US Treasury bond 10-year market still signal underlying weakness? It does. It certainly does. But the Fed is and interest rates going lower it does certainly show weakness. But the fact is that there's still money in the world, and it's got to go somewhere. And people are always going to be weighing off one asset class, one investment avenue to another, and that is why we have to trust the price action. And certainly you could find you put your capital in some of the places. If you think that interest rates going lower and lower are really showing underlying weakness, that you might look at some other asset classes to invest in. Right, Andrew is saying, looking at the rally since late March seems an incredibly low volume. This suggests it will fall over. I've got to trust volume less and less over the years. When I first started my technical analysis career in the early 90s, it was big, it was huge. And the more I've looked at volume over recent times, and that is just because the liquidity was so much lower in the early 90s. And when I look back at charts, when I was doing my analysis and research into the 80s and 70s, you're looking at at banks like ANZ turning over $4,000 to $10,000 a day. And so it is really, really low. So therefore volume played a big role when you're looking at charts in the 60s, 70s, and 80s, and certainly even the 90s. Whereas with the massive liquidity we have in the stock market now, volumes play a much lower role, I think, in doing your analysis of where things are going. So I don't. If it does fall over, it's not going to be because of volume. It's going to be other variables are going to play a much bigger role, Andrew, in where the market goes in the volume. Interestingly, a case from Brian, the Roaring 20s followed the end of World War I and subsequent 1917, 18 Spanish flu, barring another war, extreme nationalism rearing its ugly head and global trade suffering, then perhaps secular bull market has some legs yet. If history is anything to go by, it would be interesting to research the market data prior to World War I and following the Spanish flu. Right. Well, we did some of that in one of our other sessions. I did look a few weeks ago at what happened following the Spanish flu and what happened following the 1929 crash. And the 1929 crash certainly went all the way to whatever it was, 86% fall. But the actual depression started in the 1929 to 1931, 32. But the depression then went for another 6 or 7 years after that. And what the stock market did during the depression was positive. And that's why, and the economy was not good in those 6 or 7 years following the 1929 crash, 1929 to 1931 crash, 32 crash. But when the depression was actually there, the stock market did well, and there was plenty of time to profit from that. And the same thing happened, in other periods where we've had big crashes and big falls in the stock market. And even though there's been recessions and negative economies, the stock market has done well. So if you do research that time, and I have looked at it, Brian, is that following the bad news, following the actual living through the bad times, or what starts the bad times, the stock market's typically done well when that's been taken into account. So it's the old sell on rumor, buy on fact, or buy on rumor, sell on fact. Sorry, is that when we're living the fact, the stock market seems to do okay. When we're in the middle of the bad times, the market does all right, but it does poorly when the bad times are predicted or when they're starting. Right, is it just me or is the audio okay? Craig L. noticed AU banks all went up 6% yesterday. Any specific reason? One sparrow does not a summer make, Craig. There's going to be volatility in the banking space as all this news plays out and the role that they play in it. I'm not going to read any, and I'm not one for looking at reasons after the fact either, nor before the fact for that matter. And just look at the price action. Right, Michael is saying, thank you, Gary, love your work. Thank you, Michael. Deborah, thanks for making the learning. It's a pleasure. No questions here. Okay, all the rest is any more questions? No. Okay. Jethro is saying, I can't see an earlier question. Jethro is saying, use 2 or 3 banks. Okay, there we are. So Jethro is saying, I guess in response to the one earlier about the $1 million and where to put it in the 250 guarantee, Jethro is just suggesting they spread it over more than one bank and get the 250 for each one of those. That's another obvious one, which I didn't think of. Robert is saying, using the ATRVE, would you consider CSL as a valid equal weighted bar based on its buy signal on 9th of the 4th with ATRV still about 3.5 and price well below action price considering? Okay, so what Robert is asking here is he's looking at the volatility of the individual stock being CSL and questioning whether, because that volatility is high, should it be getting an equal position size in a portfolio. Okay, now I haven't done this research recently, and maybe I should because we've got great data now, but I did do it on the US market going back in the early 2000s and also in the 2008 period, because there was more data available there for high volatility stocks. And I did this with respect to looking at making the position sizing for SPA3 Investor similar to the position sizing in SPA3 Trader. where in SPA3 Trader we use a percent at risk, which is a volatility-based pricing position sizing algorithm, and it's pretty sophisticated. And we looked at that for SPA3 Investor, and the research came out that there was no benefit in doing that. So the answer to that is no, Robert. There's no benefit over the long term of using volatility-based or percent at risk based on volatility, which is really what SPA3 Trader does. We give it different position size based on the volatility of the stock. And the SPA3 Investor, the research came out and said it was not worth the effort and complexity to do that. So no, it's not. We're not going to do that in this case. Certainly not as SPA3 Investor. But that doesn't stop you doing it if you want to do it. I suspect though that over the long term you'll find that you're not going to improve your risk or take less risk, and you're certainly not going to improve your returns by doing it with SPA3 Investor. Right, Mike is saying, what role do you see gold having in the portfolios moving forward, particularly if markets do trend lower, confirmed recession, and possible secular bear market emergence? What gold entities would you look to utilize in this respect, both USD and AD denominated? And finally, would you look at gold direct in one form or another, and or miners against again AUD and USD denominated? Okay, so effectively what Mark is saying is what role do you see gold, either the hard asset, maybe even the ETF, and also the gold stocks? Well, the only exposure that in SPA3 Investor that we have to gold stocks is really Newcrest, and in the US we have it in Freeport McMoran, FCX. Those are the only two real gold plays that we have in SPA3 Investor, and at this stage, gold hasn't reacted like it should have, given the size of this this issue that's hit the world at the moment. It really should have reacted more. I'm getting emails and all sorts of things from all quarters saying that gold is going to go to 3,000, 4,000, 5,000, like people were saying when it was on the way up to 1,900, and it hasn't reacted that way yet. But from a SPA3 Investor perspective, there's only those stocks that we can get access to. How might gold react to this? Well, typically gold stocks do well when we have inverted yield curves and we have long interest rates close to short interest rates. And they didn't really react in late last year, in the third quarter last year, when we saw the yield curve invert. And we haven't seen them react that much recently either. Maybe just in a short-term rally, but certainly not on some kind of sustained trend. So to answer that, sure, gold can play a role from a hard asset perspective, as we spoke about earlier, but it's tough to say. You could, if you want to, and if you've got enough capital and enough inclination and time to do this, you could set up as I've had a discussion with some other members about, a satellite portfolio that specifically looks at gold stocks, and you could use SPA3 Trader to do that. Or you could come up with a pretty basic system, if you like, technical analysis system that sifts through the gold stocks. A lot of them in Australia are still pretty liquid, but there are some major players, and you could look to put some timing on gold stocks in a gold portfolio that's a satellite, maybe 5-10%, depending on how much capital you have, as a satellite of your overall investment capital, and fit that into the core satellite framework. And that would be a really good way of handling it, rather than trying to fit it into your overall in one or two existing portfolios that you have. In the same way as if you looked at gold as a hard asset, you'd also fit it into your core satellite investing framework, and you would have an allocation for it that you would free up some cash, and there'd be an opportunity cost. You would be taking some cash away from somewhere else that would be typically in some other strategy, and you'd be putting it into a gold hard asset strategy. And that's all valid. There's no one right way of doing this. And it's a case of just using that core satellite framework to allocate to strategies, and what capital you allocate to strategies based on risk and reward. So you could certainly do that if you have a view of gold stocks playing a role. Allocate a little bit of capital. It's a gold satellite, if you like, and it's only going to look at gold stocks, and you can use SPA3 Trader to do that, even though SPA3 Trader is still high risk at the moment. Overall, you could go into the particular sector and look for gold stocks and operate SPA3 Trader just on gold stocks. There's a suggestion of how you could do it. And that could then play a role in your investment plan. Right, we're out of questions. That's the last one. Thanks, Mike. Wow, we've been going nice, juicy session. What we might do is finish there. I think it's a good. Oh, here's Thomas is saying. Thomas is saying another question: having Sprott ETF and gold and silver as a security if hyperinflation eventuates in a financial reset. Absolutely, Thomas. That's quite. You could do that. It's just that if things really, that's certainly a hyperinflation environment, so everything goes along. But if we have a financial reset totally, and the financial system goes into a real huge meltdown to the point of maybe like the scenario that was being spoken about earlier, then ETFs are not really going to help you in that environment. You want to get outside of the market. But if we end up things aren't that bad and we have a hyperinflation environment, which a lot of people have been predicting since the GFC and hasn't eventuated yet, then that is a way of doing it. So you could have, and again, you could even set up a separate satellite that looks at, this is my hyperinflation risk reward allocation of capital to a specific portfolio. It's a satellite, very focused, very specific to handle that kind of environment. And if we get partway through it and you see the inflation isn't going to be a scenario that plays out, then you can say, okay, that satellite played a role while I had that view and it was a risk reward play in my overall investment plan according to the core satellite strategy, and I'm happy to turn that strategy off now. So you can, and that's the wonderful thing about the core satellite framework. It really does allow you to be very flexible in how you structure things. So you could have as many satellites as you like, and you could have, let's talk about it, the hyperinflation strategy, and you could have the gold stock strategy, and you could even go into other parts as well. So flexibility is there. It just comes, put it into the picture, write it into the investment plan, come up with the strategy, and then execute it. So that's a brilliant way of being able to handle it. Right, those are all the questions. Thank you very much for your time and attendance. Hopefully that's now set. I've done the summary. I won't do it again. We're still intact, and we'll be back in 6 months to see where this goes. It's still going to take some time to play out. In the meanwhile, the public portfolios are in the market. We're taking risk, and we're doing that because we have our protection on the downside through our exit strategy well and truly in place.